All right. Welcome to the Erik Williamson Show, where we review the best books and courses in sales, investing, and trading and business. This is episode number 28. I have Bobby with me, Bobby Casey. He's actually been spent over 20 years helping entrepreneurs and investors design location, independent lives, minimizing taxes, and managing risk with international company structuring. He's a very successful business owner. I'm so grateful to have him on the show. And of course, we have the disclaimer: this podcast is for entertainment purposes only. This is not financial, legal, or tax advice or services. I'm not a licensed financial advisor. Always do your own research. Consult with a licensed financial professional, tax professional, or legal professional before making any decisions. And before you dive in, if you're enjoying the show, please rate and review us on Apple Podcasts and Spotify, and people find the show. So thank you so much for listening to the Erik Williamson Show. Bobby, welcome on. You're a guest on the podcast. If you can just tell me a little bit about yourself and maybe your journey in entrepreneurship. I know I've been an entrepreneur myself since I was 18 years old, and it's usually a tough road for most entrepreneurs. Not all of them make it to the top right away. So
Yeah,
maybe your story is a
sure.
little different or things like that. I know my story's been like that too, but if you can just tell me about yourself so listeners can learn more about you.
Sure. Yeah. So first of all, Eric, thanks for having me on the show. I appreciate you taking the time to bring me on. Much appreciated. Uh, my name's Bobby Casey. I am originally from North Carolina. I am a lifelong entrepreneur. I started my first well, let's say I started my first business when I was a teenager, but that's always, little stuff like mowing yards and cleaning up leaves and stuff like that. I had, normal like kid jobs through school, but I haven't had a real job actually my whole life. My first real business I started when I was 19. It didn't do very well. I started another business when I was 20. Didn't do very well. I started another business when I guess I was 21 at this point, either late 20 or just turned 21. And that business did pretty well. That was, it was a long story, but we started out assembling bicycles at Walmart, um, and grew that business over the years, which sounds silly, like just assembling bicycles for Walmart. But we started out doing that, and the business grew over the next several years. We were doing a lot of assembly and installation for retail clients, doing a lot of work for like Walmart, Home Depot, Lowe's. Then we got into home installations for like sporting goods chains. We actually were a national contractor for Sears at one point, back when Sears existed. We covered about 2/3 of the zip codes of the country for Sears. We did the installations for about half the Dick's half the Sports Authority stores, about a third of the Dick's Sporting Goods stores, Sports Chalet, Academy Sports, a lot of sporting goods stores. So like, if you bought like a basketball goal at Dick's Sporting Goods or Sports Authority or something, we were the ones that came to your house to install it. Or if you bought a pool table from Sears, we were the ones that came to your house to install it. So that business did pretty well. I ended up selling that business in my 30s. I'm 51 now. I ended up selling that business in my 30s. And during that period of time, also, like in my 20s, I had a couple of other business ventures. I owned a restaurant. I had a real estate business, a couple other things. I ended up buying some of my competitors in the assembly business and merged them together to make a bigger company. And so how I got where I am today was kind of from that process. Is I had a bunch of assets. I was making pretty good money at a pretty young age. I mean, I was like 26 or 7 or something like that, and I had a couple of businesses, and I started being concerned about number one, taxation. Number two, having the proper company structure, also protecting my assets, protecting my business, protecting my personal assets, my real estate assets, restaurants, stuff like that. And Just a quick rewind. I grew up in an entrepreneurial family. My grandpa owned with a partner like a chain of restaurants, and my dad had a construction company and a real estate development company. So growing up, my upbringing was never like, hey, you should go to school, get a good education, get a good job, work 40 years and retire. That was never any conversation we ever had sitting around the dinner table when I was a kid. Like when I was, and my dad was an accountant, like trained accountant, but he was an entrepreneur, owned his construction company. And my dinner table talk when I was a kid was, let's talk about company structure, property company structure, S corps, LLCs, C corporations, 401ks, you know, company buyout plans, tax optimization. Let's talk about trading stocks at dinner tonight, how to read a balance sheet. Like these are the types of things we talked about at the dinner table when I was a kid. So, you know, in a way, I was fortunate to have a dad and a granddad who kind of had that mindset. And then, you know, I went straight into business pretty much at 19. And then around, like I said, late 20s, I started having some fears, concerns about like my asset structure and taxation. And so I went and hired a guy basically like me that does like the same stuff I do. Um, and he helped me kind of develop an asset protection plan around my assets and, you know, these types of things. And when we did that, I thought, you know what, this is pretty interesting. I really like it's like solving puzzles and it's working with other entrepreneurs. And those are people I like. I like all my friends were entrepreneurs at that time. I didn't have friends that have jobs. I don't think I literally knew anybody that had a job. Basically, everyone I knew at that point was an entrepreneur or an entrepreneur that rode motorcycles. Because you know when you're a business owner and you're like yeah, sure, you work your ass off, but if you can do it, you know, you're like, hey, I want to go ride motorcycles Thursday morning, and so you can't really do that if you have like an 8 to 5 kind of job. And so I had buddies that were
Exactly.
entrepreneurs that rode motorcycles, and we'd be like, hey, let's go ride motorcycles on Thursday and blow off work. We didn't have to ask our bosses off to go ride motorcycles. So everyone I knew was entrepreneur motorcycle riders. So, um, but anyway, I hired a guy like me and I became really fascinated with that model. Everyone I knew was an entrepreneur. So I went back to the guy that helped me and I said, what if we help some of my friends that are entrepreneurs? Because I think they need, you know, the same kind of structuring that we did. So from that point, like I worked with a couple of my friends and helped them. And we kind of worked together with this guy that helped me. And kind of over the next couple of years, that became, let's call it a side hustle for me, where I was just kind of doing a little consulting with some friends that I knew. And then I ended up selling the restaurant. I sold like my real estate business. I sold the assembly business. And I just kind of had, you know, well, I had a big moment in my life about then. I had a motorcycle crash where I almost died and I had some other issues going on. And I thought, you know what? I'm not really happy with what's going on in life. So I ended up selling the company and everything. And I said, you know, I need to do something that is more suitable to my lifestyle. And I thought, well, I'm doing this consulting thing, helping clients, you know, properly structure their assets and tax optimization and asset protection and stuff. Why don't I just formalize this into a business? And so that's what I did. So I've been doing that for around 20 years or so now. And over the course of that period of time, I recommended people to do certain things like, hey, you should set up a trust or you should register your company here. Or if you're a location independent business owner, you know, maybe you need virtual mailbox or virtual office and all these different things that I kept recommending out to my consulting clients. And then I started thinking, I don't really like recommending all these things to clients. I'm just going to start all these companies. So that's what I did. So now kind of my core business, like I still do the consulting, I'm an international tax lawyer. I do consulting with like location independent entrepreneurs, helping them with like company structure, tax optimization, asset protection, residency planning, that type of thing. But kind of my offshoots of that, I started a trust company that's down in the Caribbean, and then I started this other company, Business Anywhere, businessanywhere.io, and that's kind of my main business now is Business Anywhere. And we do like company structure. We do company formation. We're a registered agent in all 50 states plus the territories. We help people getting their bank accounts open, taxes, bookkeeping, trademark registrations, basically everything to do with your company compliance, stuff like that. We're basically a kind of a one-stop shop for startups to get their business going. And like we work with basically anybody need to register a company, but from kind of our niche that we kind of focus on, we basically focus on location independent entrepreneurs is one niche. And then the other one is real estate investors. So,
Yeah, so that what you said was critical because I'm a real estate investor myself. I own properties. I've done them in LLCs.
yeah,
Tax I'm very familiar with. And also being a business banker at major banks, uh, one thing is critical is when you're incorporated, you get better loans through banks because
yeah,
the banks like to lend to corporations. And also, too, the other key thing is that personal guarantee. Because when you're in business for yourself, there's liability, and when you're a sole proprietor, you have that unlimited liability.
right.
Whereas if you're incorporated, it's limited. So that's really critical.
It's
And
it's pretty involved. The whole asset protection planning gets pretty involved. Like I can tell you in my experience, like I've been doing this for more than 20 years, and I would say when I consult with like real estate, even real estate investors that have been doing this a long time. I mean, shoot, even I've consulted with real estate attorneys who come to me to help them structure portfolios for their own clients because they don't know how to do it correctly. Um, and what I found is 95% of real estate investors make critical mistakes when it comes to their real estate portfolios. Like, for example, you mentioned if you're a sole proprietor, if you're a real estate investor and you say, well, I'm just going to, buy this rental house or this apartment building or this, strip mall or whatever, and I'm going to title it or deed it into my name. I mean, that's a grave, grave mistake because you just opened your, not only the liability associated with the property, but then if something happens on that property, people can come after your personal assets, your home, your cars, your investment accounts, other businesses, all, your vacation house, all these other things. So that's like step one. You should never own any investment asset in your own name. But then number two, a lot of people say, well, I'll just put it in an LLC and that'll be fine. But it's also not quite as simple as that. Like the way you structure the LLC, the state you register the LLC in. If you register your own LLC, like if it's do it yourself, like you say, well, I don't want to pay the fee for a registered agent. So I'm going to go to the Secretary of State website and I'll just do it myself and I'll be my own registered agent. I mean, that's a critical mistake. That's a massive, massive mistake. I mean, I have countless stories of people who did that. They registered the LLC themselves, but they named themselves as the registered agent. And then in public record with the Secretary of State, their name, their home address is in public record. Their LLC gets sued, but then they sue the individual as well because they found your name and your home address. And then you've got process servers serving you papers at home at dinner time and stuff like that. So like that's a major mistake. I have lots of stories where people did that thinking I'm all protected because I'm in an LLC, but they're really not because their name is still all over it. I mean, there's a lot of different variables there, like different states. If you have a single member LLC, it doesn't work as well as a multi-member LLC because they can disregard the entity and,
yeah,
look at the assets inside. I mean, there's so many mistakes people make on that. So, of course, if you're just starting out and you say, oh, I want to save $100 a year or $200 a year and you want to do it yourself, that's fine. But I can tell you, if your wealth continues to grow, you're going to get to a point where that's going to be a problem for you. At some point, you're going to need to talk to a professional to get that stuff sorted out.
Yeah, and there's also the FinCEN that has to be done. I know when I have my LLC, that's critical. And then making sure you do the proper taxation because
Which
LLC,
one? What did you see?
FinCEN, FINC, yeah.
Are you talking about the BOIR, the beneficial?
Yeah,
So
yeah.
that's no longer required as of March
Oh, okay,
26th
cool.
this year.
That's good. Yes, I know that was really big for people to do properly.
So as of March 26th this year, or sorry, last year, 2025. So almost a year ago, it's no longer required to do the beneficial ownership information report. The only time, if it's a U.S. registered entity, you don't have to do it. It is still a
Okay.
thing, but it would be, let's say you're a German, let's say you want to get a job with this German company, but you live in Ohio. Well, this German company would have to register their business to conduct business in Ohio in order to hire you as an employee. Well, that German company registering as a foreign entity in Ohio would have to do a beneficial ownership information report because they're a foreign company registering to do business in the US. But if it's a US registered entity, you don't have to do the BOIR anymore.
Okay, that's good news. Yeah, that's good news to know.
Yeah.
Um, and also, like I said, incorporation is very critical for business. There's a lot of stories of people getting sued and then losing their personal assets because they're not incorporated correctly. And then there's also people who are incorporated, but they don't do the formalities right. And then the asset protection fails because they didn't do it
Right.
right.
Well, that's a good point. So if you have an LLC but you don't have a properly drafted operating agreement, the the reality is if you have an LLC and you don't have a properly drafted operating agreement and you get sued, then you're going to fall under the state regulations on how to deal with that LLC. Whereas if you had a properly drafted operating agreement, they have to look at the way the relationship between you and the entity is under the terms of the operating agreement. But in absence of that, they just go by the state regulations. And so a lot of people are like, oh, but I don't really need an operating agreement. Okay, technically, you don't legally need one, but it's a really, really terrible idea to not have one.
Yeah, yeah, I agree. So,
And
um,
you mentioned corporations. Like if you don't have your proper bylaws drafted, if you're not doing your proper minutes every year, you don't have your books, you don't keep your books up to date and stuff like that, um, and you get sued, that does not look good for you in court. They can pierce the corporate veil. Another big mistake people make, especially like small business owners with LLCs, they'll kind of use the LLC bank account to pay for personal things. And then sometimes they'll pay for business expenses on a personal credit card. And you're kind of commingling like personal
mingling
funds,
funds. It's
business
mingling
funds.
funds.
Yeah. And if you end up doing that and you get sued, the judge is going to look at that and say, well, you treat your business like your personal funds. So we're going to treat it like your personal funds in court.
Exactly, exactly. And especially real estate, when I own rental properties, having LLC was critical too. I was advised to have a LLC per rental property, depending on the value of the property,
Yeah.
how valuable it is, how much equity you have in it. But that makes a huge difference. And the mistake I made for my LLC in Atlanta is I did it. I just filed with the secretary directly, and I didn't do it right. Luckily, I didn't have to worry about liability because I shut it down. But the other LLC that I formed for my coaching business, I did through a Nevada real estate attorney, uh, and then and I was able to get the right formation. But he was critical talking about you have to do the minutes and you have to do it correctly. So you not only have to do the minutes, but you have to do them correctly as well. So I
Yeah.
know there's. I'm not sure. Does your company offer a service to do the minutes for the business owner so they don't have to?
We don't do the corporate minutes. I mean, that's more on your end. You would do that with your executive team. But basically, you have to have your annual meeting, and you keep your minutes for your annual meeting, and then that just goes into your corporate file. You would do that maybe with your accountant, or if you have a business attorney that works with your company. But generally speaking, if you're a small business, you probably don't want to be a corporation anyway. You most likely you want to be an LLC. So you don't do minutes with an LLC, not necessary. You can have annual meetings with an LLC if you want to keep up with it, but it's not required with an LLC. Whereas you do need to have it with a corporation.
This is a very good podcast for business owners because learning about asset protection and also tax advantages. Can you talk more about the tax advantages for being incorporated? Because I know from personal experience, I was able to get more tax write-offs.
Sure, I can talk about that. I want to rewind just for a second because you hit on something with real estate that I wanted to add to that. You mentioned about you were advised to hold each property in a separate LLC. So I want to make a point to that because I hear this a lot. People, you see it all the time, especially like on Reddit and in other forums and stuff like that. People are like, oh, you don't need to have an LLC. All you need is like a insurance policy or an umbrella policy, and that's all you need. LLCs are a waste of money. That could not possibly be more wrong. Like, and I'll give you an example of this. Like, let's say you have a rental house and you say, I don't want it in an LLC. I'm just going to have an insurance policy and an umbrella policy to cover myself. I don't want to waste that couple $100 a year for an LLC. Waste, I'm joking, obviously. But like, for example, let's say you rent that house out to somebody and that somebody decides they become entrepreneurial, let's say, and I mean entrepreneurial in the sense that they're going to build a meth lab in the kitchen. And
That does happen.
And it happened. I've got a good story for this actually happening to a client of mine. But they build a meth lab in the kitchen and the house blows up. They kill somebody or somebody gets hurt or burned or whatever. Well, guess what? Your insurance policy is most likely going to have a fine print item in one of those 300 pages of fine print that you didn't read and signed off on. They're going to have a fine print item there that says they don't cover any losses that are associated with criminal activity. And they're not going to pay anything on there. Keep in mind, an insurance company, an insurance adjuster's job working for the insurance company, his entire job is to find loopholes to not pay your claim. That's his whole job. That's an insurance adjuster's job, is to figure out how to not pay your claim. He's looking for loopholes to not pay out on your claim. And so if he can find any loophole in there to not pay out on your claim, you're not going to get paid. And so let's say now you got this house, the meth head blows up the house, kills somebody. The family sues you for $5 million. And now your insurance company doesn't pay out on a claim. Well, you own that house personally as an individual. They're going to sue you, the owner of the house. And now they're going to be able to come after every asset you own, your house, your cars, your mountain house, your beach house, or whatever you got, your investment portfolios, literally everything, because it wasn't shielded. You didn't segregate those assets. Whereas at least if that house was in an LLC, they can sue the owner of the house. If the LLC is drafted correctly, they can sue the owner of the house, and the house is the only asset of that LLC. So you're limited. Remember the term limited liability. That's what an LLC stands for, a limited liability company. The liability is limited to the assets of that entity, which is that house. Sure, you may lose that house in that lawsuit, but you will shield your home, your vacation home, cars, investments, all these other things. You'll shield it away. And just keep in mind that insurance policy you think that covered you for the purpose of saving you, let's say $200 a year for an LLC, it doesn't do anything for you if there's criminal activity. And that's literally one out of probably 500 different ways they can find loopholes to not pay out on your claim. So it's crazy for you to own any investment asset, especially if there's any type of risk associated with it, in your own name. It's absolutely crazy to do that. You're risking not only you, but you're risking your entire family's financial future for what purpose? To save $200 a year on a registered agent fee? Like it's crazy. So But that's one point. And then the other point is you mentioned having each property in its own LLC. For sure, that protects you. Let's say you had 10 rental houses and each one of those 10 were in their own LLC. One of them has some event, we'll keep using the meth lab as an example. Somebody blows a house up at a meth lab. Well, you have 9 other houses all segregated into separate LLCs. They can't touch any of them. They can only touch the property in that one LLC because they can only sue the LLC that owns that one house. To take that a step further, some people say, well, I don't really want to keep up with, I got 10 properties. I don't want to keep up with 10 LLCs. I'm going to have one LLC own all 10 of my properties. Sure, you can do that. But now, again, in the event that you have a $5 million lawsuit against you, they sue the owner of that property, which happens to be an LLC, but that LLC happens to own 9 other properties. If you lose that lawsuit, you're going to lose your whole portfolio. Maybe. I mean, depending on the value of the lawsuit and the value of the properties, but you can potentially lose the whole portfolio. Maybe they can't come after your personal house or your beach house or your cars or your stock portfolio, but they could come after all 10 of your rental houses in that scenario. So, but there is a trade-off there, right? Like if you're investing in like really low end, I don't know, middle of nowhere, Kansas, $40,000 rental houses or something like that. Yeah. I mean, it gets a little tedious for every single house to be in a separate LLC. I mean, just for simplicity, you might want to group 2 or 3 of them together in an LLC in that case. But just keep in mind, if you have 3 of those houses in one LLC, you get a lawsuit from one of them, you're probably losing all 3 of those houses. But I would only consider that if they were low value properties. But if you had, like you just got to look at it like this. What am I willing to lose? And should I do something to protect all my assets? Like, what am I willing to lose? Because, I mean, the U.S. is an extremely litigious country. I mean, last time I looked on the Bar Association website, it's something like there's a new lawsuit filed on average like every 6 seconds in the U.S. or something like that. I mean, it's crazy. So,
yeah, it definitely is.
And the more money you have and the more assets you have, the bigger the target is on your back because, like if, just for example, Eric, let's say you do something to me, whatever, and I'm going to sue you. I go to my attorney over here and say, hey, I want to sue this Eric guy for $1 million. Well, what's going to happen is my attorney is probably going to tell me, okay, Bobby, let me look into this and I'll get back to you. Well, what that means is that attorney is going to do a record search on you. They're going to go find out, what does Eric own? Does he have any houses in his name? Does he have any rental properties in his name? Does he have any companies that are associated with him? So that's another reason why you don't want to be your own registered agent, because I can do a record search in the state of Indiana and see every company where your name is the registered agent for it, or your name is, or your address. I can also find your home address like that if you're the registered agent. But if I was the lawyer, I'm going to do a record search on you to try to find whatever you're worth. I'm going to pull up probably a credit report on you. If I see that you have, an Amex Platinum card, I can speculate because I know about how much you need to earn to get approved for an Amex Platinum card. I can see how much you owe on your mortgage on your house. I can look on the record search and see how much that house is worth, or at least the tax value of it. So I can get kind of a financial picture of what it looks like. However, if you have all of your assets in an LLC and that lawyer does a record search on you, he can't, if they're done correctly, he can't find anything. He's going to come back. That lawyer is then going to come back to me and say, okay, Bobby, I tell you what, I can sue this Eric guy for you. I was thinking about taking it on a contingency, but I can't really do a contingency in this case. I'm going to need a $10,000 or a $20,000 retainer to move forward with the lawsuit. You know what I'm saying? If he found a bunch of assets in your name that were easily attachable, like let's say you had a house worth $1 million with a $200,000 mortgage. Well, right off the bat, he knows you have $800,000 in equity in your house. If he sues you, he can slap a lien on your house and we can just wait on you to sell it to collect on that payment. He can go, or he can even foreclose on your house. He can go after rental properties if he sees they're in your name. If he doesn't see anything in your name, it's like, he doesn't see that gold at the end of the rainbow. So he comes back to me and says, yeah, we'll sue that guy, but we need a $10,000 or $20,000 retainer. So, that's kind of a whole nother lever of asset protection, is keeping your assets private. So if you want me to finish, I'm kind of wrapped up with that. Do you want me to answer the tax related question, or did you have something you want to discuss about that?
I think you just nailed the point right there. The just of society, how attorneys work. It's critical for people to understand, because one thing is you work really hard for your assets and your business. Why not protect it? Because if you get sued and you lose all those assets and businesses because you didn't protect it, you lost all that time. So it took you 10, 15 years of your life and 40, 50 hours a week to build that business, and now you lost it because you didn't protect it. Then you just lost 10 to 15 years of your life.
Or more. I have a good friend of mine from Arizona who had a lot of property, like multi-unit properties, like apartment buildings, and he did not have everything properly protected. And about 15 years, and he's close to 70 now, so he was like upper 15, so he'd have been mid 50s when this happened. He basically lost everything due to a couple of lawsuits that came at him, and he didn't have anything properly protected. So 55 years old, and he had a portfolio with probably, I don't know, probably 500 to 600 doors of
It's a
units.
lot.
Yeah, well, they were multifamily. They were all like apartment buildings. So it was like a couple of like big apartment complexes he had, like 3 or 4 apartment complexes. But he lost all of it, like all of it. Like he went from riding high, had a couple of lawsuits, to below zero at around 55 years old. Like it was a big hit. Yeah, it was
Wow.
very unpleasant. So you mentioned like working 10 or 15 years and getting hit like that. Imagine working 40 years and getting hit like that. You know, who wants to go rebuild a financial life at 60 years old? You know, it's one thing if you're 30, it's a whole different animal when you're 60. So,
Yeah, exactly. Yeah, and if you can just touch bases on the taxes real quick, and then we'll wrap
sure,
up
sure.
the episode.
So, like taxes is taxes is always interesting concept. So the vast majority of our clients that I work with are what I call location independent entrepreneurs, meaning they have some type of online business or virtual business, or investments or whatever. And very often those people live outside of their home country. And so that gets a little complicated. So let's say you're an American with, I don't know, some type of online business, and you're living in Mexico, or you're living in Thailand, or you're living in, Portugal or something like that. So I have a lot of clients in this like demographic, and it gets complicated trying to figure those things out. There's a lot of tax things you can do there. For Americans living in the U.S., it's a bit more straightforward, but there's a lot of levers you can pull. Especially if you're a real estate investor, because there's massive tax savings when it comes to investing in real estate, even using non-cash losses in real estate portfolios to offset business income, stuff like that. I say non-cash losses. I'm talking about like depreciation and interest expenses and stuff like that. Like when it comes to real estate, like a really good strategy that I've seen work really well is doing accelerated depreciation on invested. I don't know if you've done that before, Eric, or you're familiar with that. But let's say we'll keep it simple. You go buy a rental house. There are like appraisers that'll come in. Appraisers is not really the right word. I guess it's accountants that come in and do like an appraisal of not only the value of the property, but they go kind of line by line and appraise the value of everything in the property. Like this refrigerator costs $2,000 new. It's 3 years old. It's got a lifespan of 10 years. It's got 7 years left on its lifespan. This washing machine is I don't know, $1,000 washing machine. It's got 5 years left. This light fixture, so on and so forth, like the stove, the appliances, the fixtures, all that stuff, and they can go through and take like an appraisal of every line item thing in the house. And instead of, so like in a residential property in the US, you normally do a depreciation schedule. You depreciate the asset over, 27 and a half years. So if it's $275,000 property, you depreciate it out at $10,000 a year. An accelerated depreciation schedule lets you go in and itemize different things in the house, and you can depreciate them faster because they have shorter lifespans. So I don't know, let's say the refrigerator has a 10-year lifespan with 7 years left on it. They'll go in and say that refrigerator is worth $1,200, and we're going to depreciate that piece of this house over 7 years. And this washing machine, we're going to depreciate this piece of the house over 5 years. So the benefit there is in the first 5 to 10 years of your ownership of that property, you're going to see probably a big loss, like paper loss on the house, because of non-cash expense, depreciation. So maybe in this case, instead of writing off $10,000 a year of depreciation, you might, in the first, let's say 7, 8 years of ownership of that house, you might be writing off $15,000 or $18,000 a year in depreciation on that house. So, and very, very often that allows you to take a paper loss on that house to offset it against other income. So what people do a lot of times, they'll do this accelerated depreciation schedule on real estate, and they'll own that property for, I don't know, let's say 5 or 10 years, or whenever you kind of run out the clock on that accelerated depreciation schedule. And then you do a 1031 exchange and roll your gains over into another property. You know what a 1031 exchange is?
Yeah, it's for investment. You can basically roll your capital gains
Yeah.
into another property. Typically,
Yeah.
it's a better investment, typically.
Yeah, it's got to be, for those listening that don't know what it is, a 1031 is a tax treatment. When you sell something, you file a form 1031. And let's say you sell a property for $500,000. Let's say you paid, I don't know, $200,000 for it. If it's an investment property, in theory, you would own a $300,000 capital gain, tax on a $300,000 gain. If you do a 1031 exchange, what happens is you need to identify another property you want to buy that you take that 500,000 or more to roll it into that other property. You need to identify a property within, I forgot, it's 30 days or 60 days, something like that. You can ask your accountant on it. I forgot the exact window, but you have a certain amount of time to identify the property, and then you have like 6 months time to close on it. If you do that, then you file the 1031 form, and then you pay no capital gains, and that it just rolls forward to the next property. So the great thing there is, if you own that house, using this example, for let's say 7 years, you've capitalized on the accelerated depreciation. You've shown paper losses for 7 years, offsetting other income. 7 years, you sell it, you roll it over to another property, you never pay capital gains on it. And now you do it all over again with accelerated depreciation on the next house. You show paper losses on that for another 7 years, presumably higher paper losses because the property is going to be a higher value now because you rolled over more money into it. And so a lot of people build investment portfolio, like real estate investment portfolios that way. It's really just a tax hack on playing around with avoiding capital gains loss or capital gains on property. But it's a clever way to do it.
Yeah, thank you for sharing that, Bobby. And then we'll wrap it up. So, where can someone find your company and your services, and where can they reach out to you? And then
Easiest way to find us is businessanywhere.io. You can find us online, businessanywhere.io. We have a contact form on there. You can schedule a call with our team. If you want a full consultation, you can book a consultation. We do Like I said, we do company formation. Like if you're a real estate investor, you need to register LLCs. We're actually the only registered agent that fully automates your state compliance too. So we like our software automatically files your annual reports, pays your state fees, everything on your behalf. So you don't even have to touch it, which is attractive, especially for people who have multiple entities and multiple units.
Yeah, well, thank you so much for hopping on the show and reaching out to me. Thank you so much for listening to Erik Williamson
Thanks
Show.
for having me.
If you found value in today's episode, please take a moment to rate and review or on your favorite podcast app. And we'll throw out that disclaimer. This podcast is for entertainment purposes only. This is not financial, legal, or tax advice or services. I'm not a licensed financial advisor. Always doing your own research to consult a licensed financial professional, tax professional, or legal professional before making any decisions. And thank you so much for listening to the show. And please reach out to Bobby and use his services. So thank you so much.
Have a great day.